Now we are going to start continue from the previous class sessions. Still we are discussing about property, plant and equipment, that is LKAS 16. Now we are going to discuss about depreciation. It's the final part. As you know, so we already discussed about recognition. Under that we have done the recognizing the initial cost and recognizing the subsequent cost under the recognition. Under the measurement, we have two components: measurement at recognition and measurement after recognition. Under the measurement at recognition, we have discussed elements of cost and measurement of cost. Under the measurement after recognition, we have discussed the cost model and revaluation model. The only remaining part is depreciation and impairment. Our focus mostly on depreciation. So for impairment of assets, it has another accounting standard, separate accounting standard for impairment of assets. So our focus totally on depreciation. First we look at some definitions of the key terms used in the accounting standard LKAS 16, especially under the depreciation. Right. Depreciation is the systematic allocation. It's very important. So, systematic allocation of the depreciable amount of an asset over its useful life. So, this definition is explained in the IAS 16, International Accounting Standard, paragraph 6. So, we have already discussed in detail about this definition in the beginning of the standards. So, depreciable amount is the cost of an asset or other amount substituted for the cost less residual value. In simple terms, what? Cost minus and residual value. So it should be divided by useful life. So this is called depreciation. This is the systematic allocation. This is one way of allocating a depreciable amount. So depreciation must be charged from the date the asset is available for use, not from the date of acquisition. The depreciation should start from available for use, that is, it is capable of operating in the manner intended by management. Also important. Intended by management. This may be earlier than, right, the intended by the use, right, and available for use. So this may be earlier than the date is actually brought into use. For example, if staff need to be trained to use it, so depreciation is continued even if the asset is idle. So for example, the asset was purchased on this date. Right, and the asset is purchased on this date, and on this date the asset is ready to use. Right, on this date the asset is ready to use, but the entity is unable to the entity does not have qualified staff to operate that machine. So therefore the entities give training to their staff members on this date, and the period ends on this date. So here, when they calculate depreciation, they have to start depreciation from on this date, not on this date, because the asset is ready to use on this date. So the depreciation should be start from this date. This means the date, from the date the asset is available for use. So on this date the asset is actually available to use, but this date is purchase date. So we can't take this date to start depreciation, because they have to some preliminary works has to be done. so site cleaning and installation, right? So testing, everything will be done. So this period no depreciation will be allocated. So depreciation should be start from the date the asset is available for use. Depreciation method used method should reflect as fairly as possible the pattern in which the asset's economic benefits are consumed by the entity. So possible methods include straight line method. All of you are very familiar with this. Reducing balance methods and machine hour methods. We'll see one illustration, so basic examples. So we don't want to much rush on this, so all of you are familiar on this. An asset cost of rupees US dollar 100,000 and has an expected useful life of 10 years. Right? The asset was purchased for 100,000, the expected useful life of 10 years. The purchaser intend to use, very important, intend to use the asset for 6 years only. The asset originally, the useful life of the machine is 10 years. Anyhow, the management intended to use this machine or the particular asset for 6 years, at which the expected residual value will be 40,000. So at end of 6th year, the residual value is 40,000 at current prices. So what is the depreciable amount? Here we don't want to take expected useful life, that is 10 years. We don't want to take, because the useful life is different from the intent to use. So that is 6 years. So therefore the management intend to use this asset for 6 years. So therefore this depreciation should be systematically allocated for 6 years, not for 10 years. Here the depreciable amount is 100,000 minus 40,000, that is 60,000 spread over 6 years. Here another illustration, depreciation methods. A lorry bought for a Titan company cost 17,000. It is expected to last for 5 years. Useful life is 5 years, and then be sold for scrap value of 2,000. So residual value of that lorry is 2,000. Usage of 5 years is expected to be, here the first year it will be used for 200 days, for the second year 100, third year 100, fourth year 50, and in fifth year 40 days only. So LKAS work out the depreciation to be charged each year under straight line method. It's very straightforward, right? So we take the cost and we deduct the depreciable amount, that is equal to 15,000. It can be used for 5 years. Then we can take the straight line method depreciation. So reducing balance. Here 17,000 minus 2,000 equal how much? 15,000, and it should be reduced depreciation for 35. So we have to do up to 4 years, and the final year in the fifth year we have to deduct again 2 years from the carrying amount of the assets, and we have to calculate the depreciable amount. And the machine hours method. Machine hours mean how many days it can be used. 200 plus 100 plus 100 plus 150 plus 40. So total we will take the number of machine hours. Sum of digit. Here from the initial date it can be used for 5 years, after that 4 years, after that 3 years remains, after that 2 years remains, and 1 year remains at the beginning of each year. So we get the sum, the total value is equal sum of digit. Here the answer, under the straight line method, the depreciation amount is 3000 per year. So it's all 5 years will be 3000. So under the reducing balance method, the depreciation for each of the 5 years is depreciated here 17,000. So no need to deduct 2000, right? Sorry for the mistake. 17,000 into 35%, and here depreciation for the first year 5,950, and then we have to, then for the second year we take the cost minus the previous period accumulated depreciation, not cumulative, right? Accumulated depreciation, then we will take 35%, that is equal 3,868. Then again the previous period carrying amount should be take here, and the previous year depreciation should be deducted, and we have to calculate the depreciation at 35%, reducing balance. And in the last year, so balance to bringing carrying amount to 2000, right? We know the residual value of the asset is 2000, no? So end of the useful life of the asset, the 2000 balance should be remains. So we have to bring 2000, and the carrying amount of the asset at the beginning is 4668, and balance how much? 2000 should be there. So then the balancing figure we will take as a depreciable amount. So how much? 4668 is the carrying amount at the beginning, and also 2000 should be a balancing figure, and additionally how much? 1634. And in the under the machine hour method, here the first year can be used 200, 100, so almost total hours is 590 days. And here we have to first find depreciable amount should be divided by total number of machine hours. So per machine hour we can take 25.42. so it's mean if the machine used for 1 hour, so 1 day, the cost will be to 25.42. in the first year it will be used for 200 days. We know that per day cost, and it will be used for 200, and we take this value from multiply here, and we will get this value. Likewise for the 100 days, per day cost is this, then we can take this value, right? So it's approximately 15,000 equivalent to depreciable amount. So due to the decimal approximation, so the difference 2.20 difference occurs. So the answer does not come to exactly 15,000 because of the rounding carried out at the depreciation per days stage of the calculation. Sum of digit methods begins by adding up the year's useful life. In this case 5, 4, 3, 2, 1 plus 15. That the first year 15,000 is a depreciable amount. Sum of digit is 5. So the first year it can be used for 5 years, and total useful life, total sum of digit 15. So likewise we have to do this. Illustration 3. An item of plant was purchased on 1st of April 2010 for 200,000 and is being depreciated at 25% on reducing balance basis. 25% on reducing balance basis. So prepare the extract of finance statement for the year ended 31st March 2002. It's very easy because it does not have any residual value, so you can do by yourself. So a change a change from one method of providing depreciation to another. Say for example, the entity has used straight line method for the first 3 years, and the entities wanted to convert the method of depreciation to reducing balance method, or they can convert it the depreciation basis on the machine hour. So anyhow, they are changing the method of depreciation. Then how to deal that situation? So this change, right? This change of change from one method of providing depreciation to another is permissible only on the ground that new method will give a fair representation of the results and of the financial position, right? So the only acceptable justification for the change of method is the management argue that the new method will give a fair presentation about the depreciation. So this change does not constitute a change of accounting policy. It is not considered as a changing in accounting policy, but it's a change in accounting estimate, right? It's not a accounting changes in not an accounting change in accounting policy, rather it considered as changes in accounting estimates. The carrying amount should be written off over the remaining useful life, commencing with the period in which change is made. So right, the new depreciation is start from the commencing date, commencing with period in which change is made. On that date they have to find the carrying amount, and so it should be written off over the useful life. If an asset is classed as a complex asset, so complex assets mean it has different parts of assets. The complex asset, it may be thought of having separate components within a single asset. For example, an engine within an aircraft will need replacing before the body of aircraft needs replacing. Each separate parts of the assets should be depreciated over its useful life. So when you take up the aircraft, say for example it can be used for 20 years, but the engine can be used only for 5 years. So therefore the depreciation separately has to be done for 5 years, and for the body can be used for 20 years, like that. So we have then review of useful lives and residual values. So useful life and residual value should be reviewed at the end of each reporting period and revised, end of each reporting period and revised if the expectations are significantly different from previous estimates. If the estimates now, so due to the changes in market price, or it's kind of revaluation, right? It's kind of revaluation. So if the amount is changed significantly, so it's differ from the previous estimates, so then they have to review about the useful lives and its residual values. The carrying amount of the asset at the date of revision less any residual value should be depreciated over revised remaining useful life, right? So when they revised its useful life, then they have to again start the depreciable amount. The carrying amount of the asset at the date of revision, that's important, right? At the date of revision, the carrying amount of the asset at the date of revision minus any residual value should be depreciated. So carrying amount minus residual value at the date of and useful life, remaining useful life. So this remaining life at the date of review, from the date of review. Illustration: a machine was purchased on 1st of April 2010 420,000. It was estimated that the asset had a residual value of 20,000 and a useful life of 10 years on this date. Here, so it was purchased on 420 and its residual value on this date is 20. So useful life is 10 years. So therefore per year depreciation will be 10,000. 100,000 divided by 10,000 equal 10,000, right? It was estimated that asset has useful life residual value of 20,000 and useful life 10 years. On the April 1st of April 2012, after 2 years, right, year 1 and year 2, on this date there was the residual value was reassessed as being 15,000 and the useful life, remaining life, was considered to be only 5 years. Now, right, useful life is 5, so remaining useful life is 5, so it's meaning end of what, 7 years, no, 7 years, 7th year. So the gap is 5 years. The gap is 5 years. Earlier the gap from the date of acquisition to useful life 10 years. Now after 2 years they review the residual value. So on this date is 15,000. So what to do? So how should the assets should be accounted for in the year ending 31st March 2011, 12, 13. So it's when the first year is very easy. So 10,000 for the first year, and end of the second year also 10,000, and in the third year it will be different. So how? Remaining useful, right? Here first 20,000. Here we first we have to take the carrying amount. How to get the carrying amount? So it's 120, no, 120 for every year 10,000, 10,000. So therefore at this point the carrying amount is 80, and the remaining useful life, the residual value is 15, so it should be deducted 15, and remaining life is 5. Then this is how 65 over 5 will be charged on each year, right? Illustration 4, revision of useful life. Alpha purchased non-current assets for 100,000 on 1st of January 2012 and started depreciating it over 5 years. So residual value was taken at 10,000. At 1st January 2013, after 1 year, a review of asset lives was undertaken and the remaining useful life was estimated at 8 years. So initially it was estimated for 5 years. Now after 1 year, useful life was 8 years. So residual value was estimated nil. So calculate the depreciation charge for the year ended 31st December 2013, subsequent year. Right here, first it was purchased for 100,000, and initially it was, the residual value has 10,000 and useful life of the asset is 5 years. So therefore depreciation per year is 18,000. Depreciation per year is 18,000. So after 1 year of use, the depreciation method is changed. So the useful life has been changed. So first we have to take the carrying value at the date of change. Carrying value the date of change. How to calculate? We know the cost. From the cost we have to deduct the depreciation. So annual depreciation is 18,000. So it has been used only for 1 year. So the 18,000, 100,000 minus 18,000 equal 82,000. So this is the carrying amount, carrying value of the asset. Then new depreciation will be here 82,000. There is no residual value, and it should be the useful life is 80 years. Then new depreciation charge is 10,250. Illustration 4, and not 4, it should be 5, no? It should be 5. An entity purchased an asset for 20,000 on 1st January 2013. Straight line depreciation of 5,000 per annum has been charged, assuming 4 years useful life with no residual value. On the 1st January 2005, the annual review of asset lives was undertaken, and the remaining useful life for the asset was estimated for 4 years. The financial statement for the year ended 31st December are being prepared. So what is the depreciation chart for the year? So you can do by yourself. So now we'll discuss about component depreciation. So complex asset. So if an asset comprises 2 or more major components with different useful lives, then each component should be accounted for separately for depreciation purpose and depreciated over its own useful life. So we can understand easily from these illustrations. A company purchased a property with an overall cost of 100 million on 1st of April 2011. The property elements are made up of the following: the land and building, so accounted for 65,000, fixtures and fittings 24,000, and lift 11,000. So total value is equal 100 million, right? It's equal 100 million. And the estimated life of the land is 50 years. So therefore this 65,000, the land component is 20 now. So therefore we have deduct 20,000 from 65. So therefore 55. This 55 should be depreciated over 50 years. And fixtures and fitting, it's 10 years. It should be divided for 10 years, depreciated for 10 years, and lift 11,000 should be depreciated over 20 years. So calculate the annual depreciation charge for the property for the year 31st March 2022. Right, major inspection and overhaul cost. Major inspections. So inspection and overhaul cost. Overhaul cost mean, for example, renovation. It's kind of major repair or renovation, right? So inspection and overhaul cost are generally expensed as they are occurred. However, they are capitalized as non-current assets. Right, the overhaul cost, the inspection and the overhaul cost can be capitalized as a non-current assets to the extent that they are satisfied LKAS 16 rules for separate components. So where this is the case, they are then depreciated over their useful life, that is until the next inspection or overhaul cost is due. Right here, to understand better, you have one illustration. An entity purchases an aircraft that has an expected useful life of 20 years. At the aircraft, the useful life is 20 years with no residual value. The aircraft requires substantial overhaul at the end of 5 year, 10 year and 15th year. So every 5 years the aircraft should be undergo a major overhaul cost. The aircraft cost is 25 million. The aircraft cost 25 million, and 5 million of this figure is estimated to be attributable to the economic benefits that are restored by the overhaul cost. Here this 25 million, the total cost, the aircraft cost. So this 5 million is the overhaul cost. It means 20 million the cost for the machine, the aircraft, then 5 million will be every 5 years. No, every 5 year the major overhaul cost will be incurred. So therefore the first 5 million considered as an overhaul cost. So in year 6 the cost of the overhaul is estimated to be 6 million. Calculate the annual depreciation charge for the year 1 to 5 years and 6 to 10 years. Here this is the answer. The aircraft is treated as two separate components for depreciation purpose. First one, year 1 to 5. As you know that the total cost is 25 million. This 25 million should be separated into two parts, two components. First one, 20 million for the aircraft, and 5 million it should be depreciated, because every 5 years there should be a overall cost, major renovation cost. The accounts for first 5 years, the overall initial overhaul value of 5 million, this means this 5 million depreciated over 5 years. So therefore per year depreciation for the overall cost is 1 million. Balance of 20 million is depreciated over 20 years. So therefore 20 million divided by 20 is 1 million. So therefore the depreciation, total depreciation for the year with respect to the aircraft is 2 million. And depreciation charge per annum is 2, right? And when the first overhaul is completed at the end of 5th year at a cost of say 6 million, then this cost is capitalized. You know, here in the year 6, it means end of year 5, the cost of overhaul is estimated to be 6 million, and here the 6 million, then this cost is capitalized and depreciated to the next overhaul. So next overhaul cost will be taken end of 10th year. Here the depreciation for year 6 to 10 years, the overhaul 6 million depreciated over 5 years. So it can be, this 6 million is valid for only 5 years. So therefore 6 million divided by 5 per year, 1.2 million. And the aircraft cost is here, so 20 million, it can be used for 20 years, therefore it's 1 million. So therefore depreciation charge per annum is 2.2 million, right? So that is all about LKAS 16.